been quite a disappointing opening for the bulls, to put it mildly. The Sensex is now down more than 1,000 points, and Reliance is actually your biggest index drag at the moment. Mahesh Patil, the co-chief investment officer of Aditya Birla Sun Life AMC, joins us now. Mahesh, good morning. Tough times for the market, and you know, a lot of gains have been wiped out in a very short period of time. That is pretty much what has punctured sentiment, especially in the retail community. What is your advice to investors watching now?
Yeah, it's true. I mean, investors, retail investors, especially in the broader market, have seen a far larger correction in the last 6 to 9 months. And I think these are tough times, okay, where we've seen stock prices coming off by around 30, 40, 50%, even for good names. I think I would say that, it's domestic. We had some headwinds. I think we are in a kind of a perfect storm, it looks like, with global markets also now kind of giving away. US, which was holding on very firm. But I think for domestic investors, I would say that they will have to tide over this period, because for the next few months, doesn't look like things would look up immediately. I mean, unless, oil, which was one of the factors which actually drove down our markets earlier in this crisis, if it comes up, I think that could be some kind of a positive silver lining in all the negative news what we have seen on the domestic front. So I think, this is a time really when one needs to start looking at slightly longer term, looking at if there is any value in the market at this point in time. Clearly, I think post the correction, there is good value which is emerging in the market in a lot of stocks now which are looking at attractive levels. We haven't still seen any kind of a major climb down in terms of earnings, though there is an argument that because of the rise in interest rates and the problem in the NBFC sector, whether we could see a slowdown on the overall consumer growth, which was driving the big driver of growth which was there. That is something which needs to wait and watch how this festive season goes by. But by and large, don't see much of an impact on earnings. It's more of sentiment which is driving the market down at this point in time. And one has to really tide over this situation, not to panic at this point in time. Markets could go down further from these levels, okay, because we have seen global markets start to correct, but I think one should hold on. And I think since valuations have come down at very attractive levels, at least in the broader market, it will be a good time to really start making some allocations in this fall with, say, a 3-year view.
Okay. October 11, 2017, we were at 9984. October 12th, we were at 10,096. So it's like a year's work has been wiped out, I guess, largely in the month of October and maybe half of September. So it's taken 1 month to wipe out 1 year's gains. We are still not at October 11, 2017 levels, but we are about 76 points away from that level. It'll be disheartening, because that's when we saw the big march into mutual funds. If you remember, that big 20,000 crore flow was September of 2017. Yeah. And then we had 16,000. You know, we had big flows at that time. Some of them could be first-time investors. So it will rankle rather badly when they start seeing their portfolios underperform so much. Mahesh, what is the sector strategy now? Is it, you know, Harindra was just telling us that, you know, staples and private corporate lenders or people with CASA are the guys you would go to. Would that be your strategy as well? How do you tide this fall?
So I think in this kind of a market where everything seems to be falling, right? This is the last leg of probably of the market where there are very few places to hide in this kind of a fall.
Relative outperformance.
But yeah, relatively, I would still say that companies, again, by and large, companies having no leverage, I think high leverage companies will face a problem, because we've seen interest rates go up. That is one area where, if you want to differentiate between high leverage and low leverage, and other companies where the earnings volatility is much lower. Okay, there is more predictability of earning, because there is a lot of fear in terms of how things will pan out, a lot of uncertainty even on the global front which is there. So earnings visibility and stability, I think, would be those companies, whether it's in the utility space or some good quality consumer names, or even in terms of the banks, as you mentioned, banks with very strong liability franchise, high CASA, stability on the asset side, okay, where asset quality concerns are not likely to be there. I think they should be able to, they'll also fall, or probably they should do better and able to bounce back when the dust settles down. I think they should be able to bounce back much faster. So I think these are the places where one would look to hide. Even IT also looks to be, while we've seen it falling today, but I think if you factor in the current rupee where it is, I think there is chances of upgrades to happen after this quarterly number. It's one of the few sectors actually where you will see upgrades post this quarter.
Okay, by the way, the market's being a bit rational today. Look at HPCL's intraday chart, and that's really presented perhaps the best trade in the morning. That in fact is now up about 2.5%. So taking cognizance of...
Would you say it's rational or it's a little bit of bravado?
No.
I mean, in many of the NBFCs, we have not even wiped out yesterday's gains.
Yeah.
I mean, we are holding out. I don't know. If you looked at the way the Asian indices have performed, it looks like we are stalling the fall in the hope that Europe has already done its fall, and if it opens in the green, probably something will come. But I mean, this is really playing a dangerous game.
Could be. But for now, we're just trying to bounce back a bit. Just a limited point I was making. But anyway, Mahesh, good morning. So, the point I was asking is sometimes, you want to invest in sectors where you believe that the worst is now getting priced in. Is oil marketing in that particular space right now? You think it could be a good investment bet from here on?
I think you're right. I think that's precisely what has happened. A lot of stocks actually got hammered at sectors, because of concerns, whether it was the NBFC space or the oil marketing companies because of the government's rollback in terms of regulation. And many of these companies are now quoting at valuations, say probably price to book value equal to 1 or below book value, multiples in single digits. Dividend yield or earnings yield are also very, very good. So that automatically finds the support, right, in this kind of environment. I mean, how low can the stock go? The earned dividend yield in some of these stocks, like you mentioned about oil marketing companies, even if you take a cut in earnings, would still be around 7% or so. So then that's an area where clearly some value buying would come in, because, see, at this moment, people want to protect the downside. I mean, no one is looking at a big upside. That's not on their mind, right? Stocks which can offer a downside protection because of strong fundamentals, or probably because valuations are automatically giving a support to the stocks. I think those stocks are good to be in this kind of a market.
So when you started the conversation, you said this is purely a sentiment-driven move on the downside and fundamentals are still good. But, just to play devil's advocate here, we are seeing some slowdown in, say, consumption growth. Demand has fallen in spaces like consumer durables, autos, etc. Would that not concern you?
No. So, yeah, there is some kind of a slowdown at this point in time. Still too early to see, because there has been some kind of a shift in terms of the festive season, right? So one has to look through that. But I think there is a fear that because of the tightness in the markets, what we have seen in the financial markets, and availability of funds to the NBFCs, which were a big lender to the consumer sector, especially consumer durables, the auto space, and they were especially on the rural side, they were a big driver for that growth. So if that availability of funds to the NBFCs slows down, I think that can impact growth. But again, the change over there because of that would, you could probably shave off a couple of percentage points in terms of growth. But beyond a point, I don't see any meaningful impact to that. And the stocks also have corrected. I mean, you've seen all the consumer names, the auto names. The stocks have already corrected in expectation of that. So it's a question about, obviously there is some kind of concern that growth will slow down. Also, the government spending this year is likely to be lower because on the fiscal side, there are some challenges. We are getting an election year, where things could stall down for, say, 3 months before the elections. So all these things are there, and that's the reason why the markets have been weak. So I think beyond a point, I would say that it's more about fear and sentiment, I think, which is driving the market at this point in time.
Would you say that, how would you advise investors to allocate between funds? Should some money go to balanced and gilt funds?
So, money to balanced fund as an allocation is always advisable, for a lot of investors, especially in times of volatility, what we've seen, and investors who are coming first time into the market. It's always a good time to get into equities through a balanced fund. So I think that should continue. I think in this kind of an environment, allocation to debt also, where especially with lower duration could be advisable. I think if global crisis kind of precipitates further, I think you might see the hike in interest rates, what we've seen, and that could moderate down. So that could also be but I think there is no reason at this point in time to suggest that one should be aggressive in any particular category in debt or in equity, because in equity also, because the correction in valuations, I think for long-term investors, I think it's a good time to start looking at, because everybody was waiting for a correction, right? I mean, a year back, a lot of investors were seeing the market corrects by around 10%. They will look to invest because the valuation will start to look attractive. So which has happened now, right? So across the asset classes, we've seen a correction. So it's time to be probably more balanced in terms of asset allocation at this point in time. Obviously not trying to get into too aggressive, whether it's in the equity, there are aggressive funds which probably one would not look into. At the same time, I would say it's not to stay away from like small and mid cap, for example. One would categorize that as slightly more aggressive and risky. But again, if you look at the correction in the small and mid cap index, I mean, the small and mid cap index is down 40%, right? Yeah. So already the stocks are pricing in. I mean, they can fall down further. But somebody with a 3-year view, this is a time to really start making some allocation to this category. So I would say that the risk and the prices are already priced in to a large extent across various categories of asset classes. Okay. So stick to allocation. I think that's the best thing, not to be too greedy and try to really increase allocation in a particular asset class. I think that should work out well, because across asset classes we have seen they have been, okay. This year, whether it is debt or equity, both have actually given negative returns.
Okay. By the way, that bravado seems to be fading now. We are again going back towards the low point. In fact, it was very interesting the way market started. It started to actually move higher, but that is being sold into now. Indiabulls Housing Finance is a stock which is now seeing a big decline, 10% down on that stock. Just pull out that stock now. 10% lower is what you have on Indiabulls Housing Finance. DHFL though has recovered a bit, but there are others joining in like Cholamandalam, down 6.5%.
Anuj, would you not say that yesterday's excesses should first be creamed out?
I completely agree.
That has not happened yet.
No, that has not happened yet. The market's trying to defend some crucial levels. 10,150 thereabout. I think it's extremely crucial. The last time also the market did take support at 10,150. But it looks a macro trigger. It looks like it will go. But it's no point standing in front of this speeding train. In fact, as we speak, even the Dow futures are down further. So it's not that they are also going to indicate any kind of recovery. So this perhaps could get sold into. But for now, 10,150 is last-ditch attempt to sort of defend that particular mark right now.
Oh, absolutely. All right. Let's thank Mahesh Patil as well for joining us.